Welcome to Key Points for January. This month, why we think the powerful surge in equity markets is due for a bit of a correction, why the newfound optimism around economic data we believe is misplaced, and why geopolitics is likely to matter more for financial markets in 2020 than it did last year. So turning to our first point, the 2019 performance for financial markets was really quite remarkable. The profound shift that we saw in monetary policy lifted all asset classes, whether it be credit, equities, government bonds, or real estate. And that surge ran into the end of the year. The S&P 500, for example, closed the year up more than 30% on a total return basis, and actually was up more than 250% over that decade. Now, the momentum has continued through year-end and we think may last a little bit longer, but we think the market is now ahead of itself. That surge that we've seen when we look at our quantitative and technical indicators imply that a pullback is due, and when you simply eyeball this kind of move that we've seen in the last 2 or 3 months, it seems likely that we have some kind of a pullback in the near to medium term. Now this takes us to our second point, which is that there has been a fairly significant shift in terms of investor sentiment around economic data. You'll remember back in the summer months, people were preoccupied by the inversion of the yield curve and fears of recession. That quickly dissipated, and now we're in kind of a feel-good factor where I think investors believe that the manufacturing recession of 2019 is a thing of the past, and are looking forward to a better growth prospect for 2020. Sadly, we think that optimism is misplaced. Yes, some of the manufacturing numbers have stabilized, although importantly not in the United States. Trade data is maybe looking a little bit less bad, but actual levels are still very, very weak. And unfortunately, we don't see any kind of pickup from here. The likelihood is that we have a continuation of a modest downtrack in terms of the growth environment globally. Now that takes us to our third point, which is geopolitics. Last year, the movement by the Federal Reserve and other central banks providing liquidity meant that investors were able to look through some of the geopolitical tensions, the tariff wars that were taking place, and as I said, lifted these financial assets. But we think there is now a change taking place. Central banks are more cautious. The Fed is on hold, for example. We've seen the tariff agreement, at least the first phase of this, likely to be signed soon. But we've seen the escalations and tensions around the Middle East, and we think that geopolitics will become more of a significant role over the course of the 2020 period because we don't have the same offsets to take place. So still a very challenging environment, and we think that's going to lead to more volatility in financial markets. Now remember, everything I said you can read in our investment insights for January, available with all our documents on zurich.com/MSME.